Hey, everybody. Thank you for joining us today. I'm Cal Roberson with Integris, the Director of Strategic Partnerships. And one of our favorite partners is IBAT. And with us today is Christopher Williston, President and CEO of the Independent Bankers Association of Texas, the largest state association throughout the nation. So we appreciate you joining us today and talking about community banking and the recent runs that we've seen on the banks for Signature and Silicon Valley Bank, probably more Silicon Valley Bank for our conversation today. So thank you for joining me.
Awesome. Glad to be with you, Cal. I appreciate you taking time to talk about this.
I know you're busy with the six kids and the crazy family, and we wanted to try to get a perspective after some of these bank failures that have happened recently, and kind of what that means for community banks and really the consumers of community banks.
Yeah, like you said, Cal, I got a house full of six kids, so a couple bank failures really is less crazy than my daily reality.
That's definitely true. So we'll dive right in. So what is it that the customers of a community bank really need to be worried about with these failures?
I hope the answer is nothing, right? And I believe the answer is nothing, especially for community banks. When you look at the failure of Silicon Valley Bank and Signature Bank is way wonky to try to understand that one. So let's just kind of focus on Silicon Valley Bank. Really the risk factors that were unique to Silicon Valley Bank contributed to its failure. And of course, we all know we've heard about the percentage of uninsured deposits, the tremendous number of deposits from the technology space, but then also just overall this kind of misreading of what was going on at the bank that found itself taking off like wildfire on Twitter and really causing this bank failure. With what we've just seen over the last couple of weeks is the first ever social media driven bank run. And that's significant, but it's also educational of if these risk factors are out there, like uninsured deposits, which could cause people in a moment of panic to rush out and try to pull their deposits in mass out of a single institution. I don't know that any bank could stand up to the type of crisis, fear mongering, just what hysteria that Silicon Valley Bank endured when Twitter turned its eyes upon it.
Man, who would have ever guessed Twitter would help take down a bank? Like
Yeah,
that's crazy. Social media is getting pretty powerful these days. So
without a doubt.
so the people that were customers of that bank, what really happened to their money? How long did it take to get back? Did they lose it all? What happened there?
Yeah. So in the case of Silicon Valley Bank, they closed down on Friday, kind of mid morning, and at that point, all funds were inaccessible. Right? They'd seen $40 billion run out of the bank in terms of deposits the day before, and that just expounds crisis upon crisis. Right? It continues to just drive the hysteria and all the people talking about pulling your money out and pull your money out before it's gone effectively. So regulators had to take a look at the situation, and they had to balance a couple things, right? They had to balance not only the unique characteristics of that organization and its depositors, but also the potential effect overall on the United States economy that could result from that bank failure. If you look at Silicon Valley Bank, you just had a tremendous concentration of deposits in that bank from the United States technology sector. So think about this for a minute. The tech sector makes up about 10% of US GDP, right? Our total economic output. And by no means were all tech sector deposits in Silicon Valley Bank, but there were a tremendous amount, right? So think of a company like Roku. Roku had $475 million on deposit at Silicon Valley Bank. Okay. Now they've got 3,500 employees at Roku. You probably have a Roku box or a Roku TV or a Roku streaming stick or something like that. So we all kind of understand and know that brand. Well, would it be the worst thing in the world if, Roku suddenly went away? Probably not, but it would definitely have impact beyond just the employees of Roku, right? You've got retailers nationwide that have Roku TVs and other things sitting on their shelves. You've got employees of the company. You've got servers out there that they're running. You've got just a tremendous other suppliers that help them build those boxes. When you think about just that as a pebble on the pond, right? Of just one depositor, if they were to open up on Monday morning without that 475 million and maybe now just have $250,000 on deposit at Silicon Valley Bank and they didn't have access to the rest, that could have tremendous implications, kind of a domino effect to affect everyone else in the value stream of Roku, right? So
Yeah.
these are the kind of situations that regulators had to look at and think about. It's just, what's the domino effect from the failure of Silicon Valley Bank? And how could that affect overall the national economy? In reviewing that, what they did is they stepped in to invoke what's called a systemic risk exemption, right? Which allowed them to expand insurance coverage to the depositors in total for Silicon Valley Bank. That means that when the bank opened back up on Monday morning under regulator control and something called Silicon Valley Bridge Bank, that every single depositor had access to every bit of their money.
So that's impressive. So really nobody lost any money at all in this scenario because they were able to use that exemption.
Yeah, exactly. So the only people that lose money in this case are really the shareholders of Silicon Valley Bank, right? They will not be made whole for the failure of this institution.
Interesting. So is there something that a bank can do to help protect assets over 250,000 in this deposit insurance limit?
Yeah. So, and this is one of the things that Silicon Valley Bank really didn't do, or I guess didn't take advantage of some of the tools that could be in their toolkit. There are networks of banks that have come up nationwide. One that we work very closely with is a company called Intrify, and it allows depositors to work with their bank to effectively spread their deposits out at other banks on a nightly basis and pull those deposits back to make sure that the FDIC coverage is expanded well beyond 250,000. I think they go up to like 50 million in coverage. So it's just a tool that you can utilize. If a depositor is worried about that, go in, ask your bank if they have any tools that would help them expand FDIC insurance coverage. There's other things, of course, you can do. You know, if you have 6 kids and you want to put all 6 kids on your bank accounts, that expands the FDIC insurance coverage for each depositor that's on the account, right? So those types of things can be done, but there are tools in the toolkit for sure.
Wow, that's the best argument I've heard for having multiple kids. You're a real advocate. I love it. That's
Yeah,
a
but the bad part is you have to give them access to your bank accounts, right?
oh man, that could be devastating for
Yeah,
sure.
exactly. There's a real risk reward balance here.
Well, awesome. Well, thank you for covering what has happened recently with those banks. Kind of jump into the next topic here. What should we expect to see in terms of other banks? Is there a likelihood of other banks failing in the next year or 2 year?
Yeah, I don't see it. I don't see that there's just this massive inherent risk out in the banking system right now, right? We've just come through a pandemic in which capital was really easy to access. I know that there's some folks concerned about maybe some credit quality just with the tightening economy, and that's certainly a factor. What we're not worried about really is other banks following the same um, path to failure that we saw at Silicon Valley Bank. Like I said, there are some really unique factors of Silicon Valley Bank in the percentage of uninsured deposits and the social media role that took place here that drove this bank failure. Those characteristics are not present in other institutions. You also just look overall, bank losses are extremely, extremely low right now, right? Banks have done really, really well over the last couple of years. Customers have been able to access throughout the pandemic era low cost capital to refinance maybe some of their riskier loans, pull down rates. We really are going into even this recessionary period that we might be entering. We're really going into it from a position of strength. That doesn't mean there won't be some hiccups along the way. Doesn't mean that there won't be some challenges to bank performance. But I really don't see in any way, shape, or form, Cal, that we're poised for bank failures. Certainly not like we were back in 2008, 2009, when we saw a lot of banks, particularly in the Southeast, Georgia, start to fail just based on how quickly they'd come into the market in the years preceding that financial crisis.
All right, thank you. So, um, is there any banks in the nation that you see as being a risk, and is that mine? Like, how can I check to see if my bank is healthy, kind of financially, or what are some signs that I should look for there?
Yeah, it's such a great question. I think one of the things I would caution is going out and trying to read bank financial reports without a real incredible understanding of how banks work. Right? That actually, when you get down to it, is a misreading of some conditions that were going on at Silicon Valley Bank is what caused the hysteria to begin with. So, I guess the question I would ask is, do you have a relationship with your banker? right? Do you feel confident enough? Go find a bank where you feel like you can walk into the bank president's office and say, tell me why I shouldn't be worried about your bank, right? I know that sounds outlandish and crazy to a lot of bank customers, but that's the type of relationship we see at community banks. In fact, if you walk into most community banks, you find that the bank president has an office with a window that opens straight out to the lobby. In most banks, they call it kind of the fishbowl, right? The reason is not just so the bank president can see who's coming and going from the bank, but more importantly, so the customers can see and know that that bank president is there, is actively engaged in the management of the bank. And that's what I'd encourage, right? Is go find that bank that you could talk to the banker about why you should be confident in that financial institution.
Awesome. Well, that's some great advice. Yeah, I do think it is very important to be able to go talk to your banker and community banker. It seems like that's one of the largest advantages to a community bank, versus a big bank. So is it is it healthy for some banks to occasionally fail, or is that
I don't know if it's healthy for them to fail or not. It's definitely it's a reality we see, right? It's never a good situation for depositors when a bank fails, even if those depositors are made whole. Just the uncertainty and the stress, right, that it introduces into life. The entire idea of the banking system is predicated on risk, right? And there's insured deposits, there's loans. You're trying to balance liquidity, capital, all these different components that go into it that get highly technical very, very quickly. Uh, when you have a bank failure, you have had a significant mismanagement of risk, right? In most cases, barring extraordinary circumstances, right? Whether you uh, agree with maybe the criticism of regulators or not in the situation of Silicon Valley Bank, there was outsized risk at that institution. The outsized risk was the uninsured deposits and the unique, highly connected nature of those depositors, right? That when a bank run started, it exploded quickly, right? Anytime there's a bank failure, there is a mismanagement of risk that is significant, barring fraud or other things that would go on. So it's not healthy, right? In a normal circumstance, you may have ups and downs. You might have bank performance go up and down with some uh, tightening and loosening of economic conditions. But really, in a well managed bank, you should never have uh, uh, you should never be towing up to the line of failure.
Yeah, that's a good point. It's probably a management issue in terms of mismanaging the risk and the management team of that bank that's causing that problem. So,
Absolutely.
well, that's enough about bank failures. That's the gross side. Of that.
Yeah. Let's move on from that.
So tell me a little bit about your opinion on this. There's a lot of pundits. I don't like to say their names because I don't like to give them any more media than they get. But
Absolutely.
basically say that the news, that there's really too many banks in the U.S. and that community banks or smaller banks are just unable to compete. Do you think there's too many banks in the nation?
Um, I don't think that there's too many banks in the nation. In fact, I think there's too few banks in the country. Uh, if you look overall, the community banks are the only financial institution with a physical presence in one of every 3 U.S. counties. Okay, think about that for a minute. So, in 33% of the counties nationwide, a community bank is the only financial institution with a physical presence. Okay. Now, that's a remarkable number. There are, of course, banking deserts that exist in this country where a town could have 30, 40, 50 miles to its nearest financial institution.
Mm.
I also think, I'll challenge this idea that these banks can't compete, right? If you look overall, what does it mean for a bank to compete? And really it comes down to, are their shareholders happy? Are they satisfied? And is the bank safe and sound and able to serve their local customers? In fact, I look at, and I think it's one of the most dangerous questions in the world that we can ask of which banks are worth saving or which banks do we need and that we don't need, right? But that's exactly what people like the pundits that you're talking about are asking. When you look at, I really think that this is an important point. When you look overall at what kind of banks we need, I think you have to ask which banks best serve the unique needs of individuals, right? All of us can do transactions, write checks, go to the ATM, swipe your debit card, apply online for a mortgage, right? There are lots of transactional things in banking. But when it comes down to it, the unique ability that smaller banks have is to have that relationship with their customers and understand their unique needs. And that means that when a man or a woman who lives in one of these smaller communities goes into their community bank and they say, "Hey, I really want to start a business. I really want to do something to help better my family," that bank is able to interface with them directly in a relational way, to understand what their needs are, what their abilities are, what the business model is that they're looking to employ to build that business, and to customize financial products and services that meet the needs of that individual and help them realize their dreams and goals, right? That is something quite simply that large financial institutions can't do. They won't do. They won't take the time, effort, invest in the overhead and the other things to stoop low down to where the customer actually is to understand that person's unique needs. So if you think people are important, if you think that people have, a certain amount of dignity in and of themselves, and that dignity and that desire, that dream that they have for themselves is worth supporting and finding a way to meet that financial need, then you believe in community banks. If you are one of these pundits who, especially those who might come from countries that have 4 or 5 banks and just don't understand what it means to actually meet the needs of unique customers, then you won't get it, right? But hopefully we can all see and understand that the ability to do customized financial services that are unique to the individual fills a place in the market that we simply can't let go, right? Those are the folks that drive the performance of our local economies and ultimately our national economy.
Right, and it sounds like it goes back to the conversation about risk. And if the big banks aren't in those small communities and know what the communities need in terms of small business, and
Mhm.
if they're evaluating somebody who wanting to open a local donut shop, and they don't know that there's no competition or a need for it throughout the community, they're going to rate that loan as a higher risk, or give them unfavorable terms because of that. So it sounds like what you're saying is these community banks serve a critical role in the local small communities in the towns that are underserved by the big banks who are unwilling to spend the time and money to put people in the small communities that need this funding, need this to survive.
Yeah, that donut shop loan you just described is a loan that big bank probably just won't make. Number one, because they may consider it too small, or just not interesting enough to them, right? The other point is that they they may not have somebody physically present to help process that loan, right? So these are you hit the nail on the head. Uh, Not only are the big banks incapable of, they're also unwilling to serve those smaller communities and customers. The other thing too that you've got to think about is, and academic research shows this: the further a bank is, the headquarters of the bank are from the customer that it's actually serving, the riskier their loan portfolio is.
Huh.
The reason for that is because they lack localized knowledge, right? They lack the ability to truly assess the risk characteristics of that community and that borrower, right? They're just doing a transaction.
Wow. Okay. So that really does make a strong point for more of a distributed banking system that is spread out and local. It seems like there's still a place for some big banks to serve some mega loans and process a ton of the transactions. Is that fair to say?
Yeah, absolutely. I mean, I think we can't act like big banks aren't necessary, right? They do serve a much larger. They can service those much larger loans. They definitely help us be competitive, not only in our national economy but our international economies as well, right? So they position us to play that. So I don't want to act like they don't have a place in this as a whole, but we have to look at, I go back to kind of that the government that's closest to the people is the one that's best positioned to serve the people. The bank that's closest to the people is best positioned to serve the people. And that's not to say that, the U.S. financial system as a whole doesn't get some benefit from larger institutions, It's just to say on a day-to-day basis, um, this more distributed banking system that you described is exactly the one that can ultimately just help lift up more and more communities and the individuals that make up those communities.
So, just on that topic is kind of another question for you related to that is, what are the things that are keeping us from seeing more community banks grow and thrive and even start? Is there something that we can be doing as an industry or legislatively that needs to happen in order for us to be able to get new banks?
Yeah, so we have to understand that one of the primary reasons that we've seen a loss. We've actually lost a third of the community banks in the country over the last decade. After the great
Wow.
financial crisis, we lost a third of the banks in the country. Now, there's a couple of factors that go into that. First was the congressional response to the financial crisis, and that was the passage of the Dodd-Frank Act, Financial Reform Act back in 2010. Okay, now what that did was it actually was trying to rein in some of the abuses that took place by the big banks during the financial crisis. It was also supposed to try to end the era of too big to fail, where an institution would have to be bailed out by taxpayers. Well, if those two were the qualifications, at least on the second, that's the most failed piece of public policy in the history of the world, because the largest financial institutions have only gotten bigger and bigger and bigger since the financial crisis. Meanwhile, so what happened was that the regulations that were designed to rein in the biggest banks after the financial crisis trickled down to the smaller financial institutions and created really a necessity of scale. So we haven't seen bank failures in community banks, but what we have seen is consolidation overall. That means that there are fewer rural markets nationwide that have a banking headquarters than there's ever been in the history of this country, right? That 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 distributed banking system that we just talked about and the need for it, that's been under attack over the last decade as these banks have tried to achieve greater and greater scale. The other piece that got layered into that was um, all of that regulation and all of that burden that gets heaped on a bank. If you were starting a new bank, you have to deal with all of that on day one that you open the door, right? So
Yeah.
you've got, you're not just starting from scratch. So historically, you could start a bank with $5 to $10 million in capital. Okay. You go get some shareholders together, you put together the amount of capital that you need. During the pandemic era, uh, I'm sorry, during the last decade, that capital requirement's gone up to 35, $45 million. Well,
Wow.
that in and of itself, right? That creates a much higher hurdle for someone to get over if they're thinking about starting a bank, right? But that's the difference in what it's taken because of that burden that's going to be heaped upon that bank on day one, right?
Right.
For them to be able to do that. What does that mean, Cal? In reality, if you look between 1970 and 2010, although we have peaks and valleys along the way, on average, in that 40-year period, we created about 150 new banks per year, every year, on average, during that 40-year period. Okay. In the last decade or the last 12 years, we've created fewer than 50 banks in the country total. Okay. So think about that. If,
Incredible.
if just your average had continued over the last decade, we would have created about 1,500 new banks historically. We've created fewer than 50, right? So you've got net losses due to consolidation and you've got almost no new charter creation going on at the same time. Therefore, you've got a diminishing number of financial institutions nationwide and a less distributed banking system.
Yeah, that's devastating. Yeah, it would be great to see some of the new bank, de novo, uh, startups actually really start to take off again. That would be, very helpful for us in the industry that we love too. So, yeah.
Absolutely.
So I think we both agree that we definitely need more community banks throughout the nation for sure, and a little bit more of a distributed system for banks. So wrapping up here, we'll ask kind of a last kind of series of questions. So, what's as a customer, why would I want to choose a community bank instead of one of the big guys if they're too big to fail and they're going to get bailed out and my deposits are insured? Like for those of us that are lucky enough to have deposits over 10 or 50,000, like why would I want to choose a community bank over a big bank?
I think you have to ask, like, really, how risky is your bank to begin with, right? Again, go back to that qualification that I started with on Silicon Valley Bank. 90+% of their deposits were uninsured. That put them in a unique position to be rushed upon in the moment of crisis and have that money pulled out. If you look at most financial institutions, their uninsured deposits are sub 20%, right? You do have some larger depositors, but also the safety and soundness, the risk profile of those banks is very, very safe. That's not to say there aren't unique situations where smaller community banks fail. But I think if you get down to the just question of, is my bank going to fail? And you look at where the failures have been historically, your community banks, especially those that have been around for a long time and have served their community well, they're not risky institutions. They shouldn't scare anybody. And in fact, uh, it comes down to trust too, right? The community banks that we talk about, the type of places that you can walk in and walk into the fishbowl of the president's office, that individual and the people that make up the management team of those banks, they feel a personal responsibility for the safety and soundness of that bank. And they know what it means to that community and what happens to that community if they go away. Right. So I'll kind of shift it on its head. Like, let's not talk about, is there a government backstop or is there not a government backstop? Maybe that's the wrong way to think about this. The question I think we ought to be asking is, does the person that runs that bank actually care about the safety, soundness, and wellness of my community? I think that creates a safer financial institution and a better opportunity for people to feel confident in in their bank.
Yeah, especially as a consumer. I know for me, so we have partnered with IBAT for years, and we get to visit a lot of community banks throughout all of Texas, throughout a large portion of the nation, really. And I've always found it interesting, as the larger the bank you get into, the further that president gets away from that glass bowl. I personally feel better as a consumer if I walk in there and I see that the person who's responsible for this is also accountable to me,
Yep.
being there. And so, having that availability to be able to go see the president, CEO, it to me brings a lot of trust in that they're doing what's best for me because they see me on a regular basis. So, I appreciate that.
Yeah, if you see your customers at church, if you see them out at civic events on a consistent basis, if you're that engaged in the community and close to your customers, you've got an accountability that I think just doesn't necessarily exist in other financial institutions.
Okay. So, Christopher, what do you see for the future of community banking throughout the nation?
The good news, Cal, is that community banking is safe, strong, sound, and well. What we've got to do is create more opportunities for community banks to be creative and really turn the tide on what we've seen over the last decade. We need uh, localized, relationship driven banking in this country. Yes, technology is great. Yes, we all love the tools and gadgets to make sure that we don't have to go into a bank branch unless we need to. But when we need to, when we want to be able to uh, to get a house or start a business or in some way create a new financial future for ourselves, making sure we have as many strong, incredible community banks available to us as a nation will only make us better and will only make the places that we all call home stronger.
Well said, Christopher. So, thank you for taking some time with me. I really appreciate it. I think that you guys, you and the team at IBAT do an amazing job and really kind of set the standard for education and training and compliance assistance for banks throughout the nation, really, and go well beyond the Texas borders and helping support other industry or other associations as well. And we're very blessed to be partnering with you guys, and think you do an amazing job.
Oh, we are too. You guys do an amazing job supporting the banks around the country and certainly here in Texas. I know the relationship is so valuable. Again, you guys are kind of that relationship based provider that is exactly what we build up and extol when it comes to banking. So thank you for being that to the banks that we both serve.
Absolutely. Well, Christopher, thank you for your time today. We appreciate it. And please keep doing a great job for community banks and their consumer.
My pleasure. Thanks for having me.